Hi there, everyone, and welcome to this month's edition of On Track. It's the 30th of October, so we've got all the news right up to date and financial results for the markets and the portfolios up to the end of September. And what a month it's been. Lots of news, a lot of it not really affecting the markets too much, and I'll dive into that. But before I do, as always, just a general advice warning. Everything I say here is general advice, not custom designed to anyone in particular's tailored needs. It's designed for clients of McGregor Wealth Management, particularly those using our care investment methodology and process. For everyone else, feel free to enjoy the content, but please don't act on this without seeking advice that's specific to your own circumstances. So what we're going to cover, as always, is what's happening in the world news-wise. There's a few key themes at the moment, so we're not going to dive too much in. There's a big thing called the election next week in the US, and that's going to dominate people's attention span, for better or for worse, and I'll talk more a bit about that. I'm going to go through the returns, and the returns are quite stellar at the moment for the last 12 months, but a little bit of catch up after some average years before then. We'll talk more on inflation, interest rates, which is still a hot topic, and what's happening with property and shares. So let's have a look. And I've kept the news limited this month because there really is a focus on a few things. The US election's a week away, so everyone's obsessed with that. A lot of investors, a lot of the market will be excited or scared or petrified, depending on what result comes in. Certain things are going to happen. As an example, in 2016, when Hillary Clinton was favorite to win, and then there was this perception that if Trump got in, the markets would go down. Trump actually got in, markets went up 10%. It's very hard to trade news, and we would never make any attempt to, whilst both sides will have certain economic impacts on the economy, depending on what they get in, and depending on what they can then implement. Keep in mind, just because someone's president doesn't mean they can automatically do everything they want. Congress, like the Senate in Australia, gets a say over what's in and what doesn't get in. So it's a system that works well to stop crazy stuff. It's going to be interesting. I wouldn't suggest anyone worries at all about the market. There would more than likely be volatility, but it tends to be short term. And I'll highlight in a minute when I go through the last 20 years exactly where the last election was and how immaterial it was in the long run. And some people get very excited about it, but enjoy the theatre of it, enjoy the spectacle. We'll talk more over the coming months about policies that actually get implemented, if they get implemented, and any impact they might have on long term. We've seen bond yields go up a little bit in the last little bit with a bit of uncertainty around the world, plus also the potential that the economy's soft landing or no landing. A bit of speculation about whether the Federal Reserve might have gone too early in that they didn't slow the economy down sufficiently. A few charts there, and I'll start with the oops. Apologies, I've just gone hyperactive on the mouse. So the top left chart here shows just where the US election, as far as the bookies are concerned. Now the bookies aren't the only source; they get it wrong, but it's in their financial interest. So they now have Trump as a favorite, and that's turned around in the last month or so. As we get closer, as I said, we'll find out next month. You can see the top right chart there, the RBA inflation forecast for Australia. We've got headline inflation coming down. We're expecting some results later today that will probably have it at about 2.9%. So that puts it in that RBA target range of 2 to 3%. But the adjusted inflation figure that the RBA likes to use is probably still sitting at about 3.5. And that's because the 0.5% difference is partially the rebates that everyone got for electricity, which has artificially pushed inflation down. So I don't think, assuming the numbers come in as expected, I don't think Michelle Bullock's in a hurry to drop rates. I think she'll probably wait longer than people think. If we did see it drop a lot, and if we did see any severe economic slowdown, that might change her pace. But otherwise, I really get the feeling she's not in a hurry. There's every chance of either either one of those things happening as well. You can see in the bottom left-hand chart here where Australia is in the red line. Our rates went up, not by as much as others. So first thing to note is we only got to 4.35. Countries like New Zealand, the UK, and the US got to about 5.35. And you'll see nearly everyone else except for Australia, or in this chart, everyone else except for Australia, the rate drop process has already started, but it's only Europe and Canada that dropped below Australian rates. So even US rates, while dropping 0.5%, are still above Australia's rate. New Zealand's made 2 cuts, UK 1. So that's kind of where they're at on the cycle there. And you can see here, once again, I've used this chart again. Inflation around the world has dropped. Australia's the highest, the dotted line there, but we're pretty much close to the pack, and we were last into inflation and last out. So I feel like we've kind of won the war. There's a little bit of debate around whether some of the countries have started to ease too early. There's no definitive answer to these things, and it's likely we've won the war. The big question now is, will interest rates drop? Not will they drop, but how much will they drop by, and how that goes through to mortgages. In terms of the rates, when we look at the charts here, no change to the cash rate, almost no change to the 90-day bank bill rate. The 10-year government bond yield has jumped 0.5%. So whenever a bond yield jumps, that has an impact on share prices. So the share market gets a little bit nervous as bond yields go up because bonds become more attractive relative to shares. Our Aussie dollar dropped a little bit, but still in that sort of mid-range, 66 cents. We're waiting for that inflation number. We'll see what that drops in at. US inflation very much in the mid-range of their 2 to 3% band. That's why they're cutting, because they've got that target. There's no change at all to mortgage rates over the last month. We're seeing a little bit of competition emerging with some banks starting to tease the market with slightly lower rates, but on average, they're kind of the same. So we're all waiting to see. Results for the portfolios are good. You'll note the 1-year column here is kind of spectacular, but I'll show in a minute how that's off a low base. So in other words, high growth portfolios for care over last year, about 20%, growth about 19, care balance about 17. But if you look at the column next to it for 3 years, it's more normal at about 6s. So that tells you that we had a bit of sideways for a couple of years, and I'll touch on that in a minute. We've made no change to our dial on where we see the market, still in that a little bit over fair value, but not quite at expensive stage. So it's in that range of fair to expensive where we're comfortable that it's okay. It may be a chance if anyone's needing cash out of the portfolio to take a little bit of profits. We're certainly rebalancing where appropriate, and for money going into the market, we're just going a little bit slower, but certainly not in any scary territory whatsoever. In my exciting life, boring money and not the other way around, highlight this time. I think we're going to see more and more news about industry super funds under pressure from regulators, and the IMF, which is the International Monetary Fund, has joined our regulators in putting a bit of pressure on the industry super funds about their operations, particularly around the way they value unlisted assets. Now, the industry super funds did a tremendous job from the 80s through to now on making the big end of town, picture the big banks and AMP, honest. They brought fees down, they invest well, but most of them carry a large bunch of unlisted assets at the moment, and they probably haven't been very transparent in valuing those, and they're possibly carrying them at higher values. So there's a little bit of stuff possibly going to happen here. Industry super funds are not required by law to have independent trustees on their investment boards. So they tend to be dominated by the political side, and you'll see that here. And APRA's got some concerns. But yeah, if you have industry super fund and you want to have a chat, please reach out. It's quite opaque at the moment. In other words, we can't get clear pictures of exactly where they're at. They've underperformed for the last 2 years because of, so for instance, I just talked about returns in that sort of 16, 17% rate for care over the last 12 months. Industry super funds are more in the 10 to 12 space because the unlisted assets they haven't put up because they didn't put them down when they went down elsewhere. So anyone in your world that has that would be happy to talk to them about some of the concerns there. It's not drop dead, get out of there type concerns, but they run the risk of underperforming and be subject to regulatory review for the next couple of years. So last 20 years, that wall of worry. So, and as I said, if you go back 2016, I think about where my cursor is there. We're coming out of a fear of slow growth and falling oil prices, and the election was about there. And the market jumped 10%. Yeah, and then sort of came back a bit, and then just the normal wall of worry. It's always hard to pinpoint market moves on one thing in particular because there's so many things going on. And as always, we spend no time trying to pick those 5, 10, 15% corrections because they're impossible to predict. But you can see we've nicely come out of the valley of fear on inflation. So all these valleys of fear that we eventually climb out of, and we're now above that. And I'm sure there's another fear just around the corner, as there always is. And we'll see what that turns into. So always expect volatility, but in the long run, we expect the line to go up like the straight line here over time, which is why we are in the market. In terms of yield curves, you'll see the yield curve across the board in both Australia on the left and the US on the right has jumped 0.5%. So that was in response to, and this is mainly 10-year government bonds. So as they start to bring down rates at the short end, which means cash rates, etc., there's a slight fear whether they've brought it down too early and whether whether they're going to need to put them up again. It's unlikely, but then the uncertainty in the world around US debt. The upcoming election can push bond yields up, which also makes share markets a little bit more expensive, but they haven't succumbed to anything crazy. So in terms of our context, we're quite firmly in the wall of worry. At the moment, we're not in boom or bust. There's always little pockets that might be in a little bit of a boom, like the Magnificent Seven that we've talked about, but the broader market quite clearly in that normal zone. And as I said, the market on 9. I'll just reiterate here, the 9 major downturns since 1900, which is 124 years. The smallest one of those is down 21%. So anything under 20%, we tend not to get too concerned about. We are concerned about the bigger ones, and we're not concerned about what markets do, because you can see here, markets always recover from those things. But we get very concerned about what investors might do, which is why we have a lot of strategy about mitigating risk around that time, including the reserves, etc. I just thought I'd stress on the mess it up component here, the short-term focus. The next little while is absolutely going to be the US election. So there's this, cross the fingers that at least we can pass to a new president, because we will have a new president one way or the other in peace and without craziness. So cross the fingers on that one, and then hope that neither side does anything stupid to the economy. Not that they're likely to do anything crazy stupid, just more the usual political stuff that, by the way, for the last 100 years, people have been doing while the market continues to grow. That bottom right-hand chart here is 125 years, so back to 1900. Great Depression, 2 world wars, Vietnam, world on brink of nuclear crisis, all the crisis we've had while the markets continue to go up. So, but the markets and the news is going to be very short-term focused at the moment. And I'll just do my keep calm alert that none of what happens will more than likely make any substantial difference to where the market will be in 3, 4, 5 years' time. But we'll see and update you over the coming months. I wanted to touch on one of my bias that's extremely common, called overconfidence bias. So overconfidence is where people overestimate their abilities and knowledge, leading to poor decision making. So results in overtrading, etc. I had one of my younger clients ring me a few months ago and said, they sat next to a stockbroker at a business lunch, and he said they should put more money in the market because if Trump wins, the market's going to go up. And that's just way overconfidence on that person's ability to understand what makes the market tick and to believe that that's almost a guaranteed thing. There's no guarantees in the markets, and we're going to see a lot of commentary from experts. Whoever wins, we're going to see the opposite side. If the Republicans win and Trump gets in, we're going to see the Democrats over catastrophize. and predict the end of the world. And if we see the Democrats continuing, the Republicans will also be predicting the end of the world. It's unlikely to be the end of the world market-wise in any case, but it's amazing how those forecasters and media heads can state things as if they know exactly what's going to happen. If they had that much knowledge, they could be trillionaires just by trading markets, and we know that they're not. So watch out, and watch out for all the opinions and stuff that are going to happen. Once again, the only warning here on that one is volatility inevitable. We will see volatility in the next year, but that's kind of the normal forecast every year. If you were forecasting the share markets every year, you'd say, I expect the market to go up 10%. It'll be volatile during the year, and at some point during the year, there'll be a 10% downturn, but we should finish the year up 10%. That's been the average forever, and obviously that finishing up 10% is an average because we get higher, we get lower, but the downturn of at least 10% or more happens every single year. It's normal, inevitable, unpredictable, and we make no attempt to predict it, just to accept it. Aussie shares, we can see a tremendous run. They've finished the month at an all-time high. They've kind of gone up a little bit, come back a bit since then. So October will more than likely be a flat month after a good return of 3% in September. No real change to those top companies. BHP, Commonwealth Bank leading the way there. But you can see once again the value of compounding. $10,000 grew to $25,000 over that period of time by ignoring the news and just letting things grow. US shares even better. US shares driven largely by big tech, or the Magnificent Seven in particular, have had a spectacular decade, up 15%. About 5% of that is kind of currency. In other words, the Australian currency has delivered the change in the Aussie US dollar, has delivered some of that as extra return. But still, Aussie investors investing in US shares have seen their $10,000 compound to about $45,000. So spectacular return. And you can see that Magnificent Seven there, which is Apple, Microsoft, Nvidia, Amazon, Meta, which is Facebook, Alphabet, which is Google, and the only one of the Magnificent Seven not shown in the US share market on this top 10 holdings of VTS, which is a holding we have in the core portfolios, is Tesla. They're just out of that. They're in the portfolio, but just out of the top 10. You'll see a few other you'll see a few other companies in there. Broadcom, Eli Lilly and Co., who are a drug manufacturer. So drug manufacturers have been buoyed by the rise in drugs like Ozempic, the weight loss drugs. So that's creating upward speculation on pricing because of profits from those drugs. So a very good year for US shares, up 25%. Global leaders, similar story, but this is international, the top 100 companies in the world. You'll see almost the same big ones as in US shares. The only difference is JP Morgan, Chase & Co. in there, I think is the only difference. The rest similar, up 27% for the year, and 10,000 compounded to 41,000. And this one's actually up since the end of the month quite strongly. We said Australian shares flat, but it's continuing to be up. Yeah, watch this space next week and beyond. See what volatility comes in, up or down. I'll make no attempt to predict what happens next week, either in the result or in the market's response, and it doesn't matter. US small caps, consistently great returns over 10 years at 12.4%, 1 year at 16.6%, slightly negative month for September, but 1 month just kind of doesn't matter. $10,000 grown to $44,000 over that period of time. Emerging markets have had a much better year. They've been the problem child for the last few years, particularly with Chinese stocks being downgraded because of the Chinese government's propensity to interfere in corporate world. We had a big jump. You can see the jump during the month there when the Chinese government announced a lot of proactive stimulus, and that's resulted in Chinese shares going up. And we'll see whether that re-rating stays over time. Very important part of the portfolio. For most of the portfolios, it's only a small part, but it's part of that diversification. And even despite having a more average decade of 5.5%, $10,000 is still compounded into about $22,000. The power of compounding Look at gold, and most of its returns have been in recent years, 32% in the last 12 months, last 3 years, 16%, but over 10 years, about 10%. So it's been rock solid and an important diversifier in the portfolio. And gold, I suspect, will be more and more valuable in the portfolios as a diversifier. We would never ever suggest someone has too much gold. Gold doesn't produce any income. So it's more a hedge type of investment rather than an income producing investment, but nonetheless an important part of the portfolio. Let's switch to the property world, where we have a similar but different model. That is, that property drifts along for a period of time, then has often rapid upturns, followed by stagnation or boring. We go through this kind of property clock. The property market, I want to iterate. I come across this slide from CoreLogic that shows how big the property market in Australia is. So it does underpin the wealth of Australia. You can see there the residential real estate market. So that's homes, 11.2 million dwellings valued at 11 trillion. So do the maths. That means the average value in Australia is $1 million for a house. And out of that, there's 2.3 trillion in mortgage debt. So that's 23% or slightly less, probably more like 20%, that 11 million, which is a fairly low. If that was an individual and the numbers were the averages, $1 million with a $230,000 mortgage, that would be unconcerning. So consumer debt is not uniform, by the way. So there's many people there that would have no debt, and other younger people or those that have pushed themselves would have much higher debt. So let's put that in contrast to the superannuation system, which in Australia holds about 3.9 trillion. So it's a fraction, it's 40-ish%, give or take, of the residential real estate market. And all the listed stocks in Australia come to about 3.2 trillion. So about a third of the value of real estate. So real estate, a very important part in Australia's wealth, but also in our psyche and the way we think about wealth as well. And commercial real estate there, you'll see at about 1.2 trillion. So only about 10% of the resi. So the resi market, extremely important. And you can see the turnover. So a couple of stats here. 56% of most people's average wealth is in their housing. And each year, well, last year, 522,000 houses changed hands at a gross value of 480 billion. So once again, it's slightly just under $1 million average, if doing some quick maths there. These charts show on the left over 12 months that the growth of properties slowed down, but it's not a uniform story. You can see that the capital cities, Perth still running hot, 24% over the last 12 months, Adelaide and Brisbane at 14%, Hobart negative, Melbourne negative, Sydney modest, and Canberra negative as well. So the average for the country slowed down about 6.7% over the last 12 months, and you can see it reached a high of nearly 20 to 30% over about a year ago. So it's settling down a little bit. And in the last quarter, which is the right-hand side of the page, we can see we've dropped to about 1% rise for the quarter. So it's a bit more subdued. I think that's a good thing. You want markets to slow down, or if they get too far, you run more risk of them collapsing, which is not good for anyone. So we'd much rather see it slow down and stagnate for a while. And just from a stability point of view, you'll see Perth, Adelaide, and Brisbane still stronger at 2 to 4%. All the rest negative, except for Sydney's kind of neutral. So interesting, slowing growth, still a little bit of growth. And we'll see where that goes, depending where interest rates go. No changes to interest rates, so really boring here. There's just no changes going on whatsoever, all waiting for the Reserve Bank. And no real change to the property clock as well. And the lesson always from a property clock and these other clocks is different parts of Australia are always at different stages of the cycle. So as much as we say last year in Australia, there was a 6% average return, around the country, there was anything from -2 to +24 in Perth. And that was just the capital cities. So there's always somewhere that's more affordable, and you can see that in the buy value, buy momentum around Perth and places like that. A lot of regional areas there. The blue chip stuff, which Brisbane, Adelaide, Sunny Coast, Gold Coast, Sydney, regional, Victoria, Bendigo, Ballarat, Geelong, and Melbourne are at different phases, from still rising to probably stagnating. Sydney, Melbourne, regional Victoria, but it's a clock. Eventually, they'll arrive in the value, and there'll be time for them as well. So there's nearly always somewhere interesting to buy for those that are looking for investments. At the moment, we're finding with interest rates relatively high, even though rents have gone up a lot, it's a bit expensive in some bits. And yeah, if we do get interest rate drops, ironically, that may stimulate the market because more people might be looking for investment properties. We know Noosa property is still going crazy, with at the top end of town, some big deals being done, and there's plenty of money around. That's pretty much it for the month, though. We're all focused, not completely, but on one thing. I'm going to be fascinated to watch from an entertainment point of view, the US election, but it's nice knowing we've got a good investment process in place. Exciting life, boring money, not the other way around. So remember that as you watch people sprout crazy opinions on everything, and maybe the markets go a bit volatile, you can know that it's kind of expected normal, and it will pass and resume its normal trend at some stage if it doesn't go up. So it'll be interesting to see. So just reiterating our strategy, yeah, all investing is best done as part of a real plan. That's where you've got your goals based on who and what's important to you. Then we just design the portfolio to meet those goals with the right asset allocation. Long-term view, get the diversification, get the asset allocation right, have enough liquidity to ride through the ups and downs, and low-cost index funds means we capture the growth of the markets without worrying about whether we've picked the right managers or paying too much in fees. Protecting against short-term volatility by reserves for our retired clients, dollar cost averaging for our clients that are building wealth still while working. We rebalance regularly. It's boring, but it absolutely pays for the cost of investing just by doing smart stuff around that. And as always, there's only 3 ways to lose your money when investing on the markets: panic and sell, having to sell, and not being properly diversified. Always pleased to say our clients do not do that. They're well set up in all those fronts, and that means they can enjoy the rising tide that is naturally the market, even though it gets a bit washy from time to time. Thank you for listening as always. As we sneak into the end of the year, I'm sure we'll have some interesting observations next month on what the market's reaction has been to the US election and plenty of other stuff going around the world. For now, it's Rob McGregor signing out.